Hi, it's Tanja. I want to share some information on passive income. Now, passive income are monies that you earned with very little or no input from you on a daily, monthly, or even yearly basis. In other words, passive income is money that you earn while you sleep. Passive income is useful or it is sought after for several reasons. One, to build generational wealth. Two, to supplement your current income. Three, as a means to support yourself through retirement, whether you've done early retirement or retire at the rightful age. And four, passive income helps you to build wealth. Now, there are 24 hours in a day, and regardless of how productive we are and how organized and how best of our time we utilize, the fact remains is that there is so much that one human being can do. And in order for your monies to grow into wealth, you are going to have to embark on passive income. The types of passive income can fall into different categories. You can have your cash and cash equivalents, you can have your business passive incomes, or you can have property or real estate passive income. The one I'm going to speak about now is cash and cash equivalents. These are types of passive incomes that you can actually embark on with as little as $100. And while you may not consider them to be passive income, if you really look at having a basic bank account, there is a level of passive income attached to that. Having a basic bank account in today's time doesn't actually earn you a whole lot in the realm of passive income. And that's because the interest rates are relatively low and has been for quite some period of time. However, most banks do have a high yield interest savings account, and that is one that you can look into. There are sometimes parameters attached to into these accounts. For example, they will say that you can get a higher rate if you make no withdrawals from this specific account for a particular quarter. And if you have some monies that you know that you are not utilizing and you would want to park them somewhere for them to actually work to give you some levels of interest, then these high yield savings accounts are a better option. You can also park those excess funds or funds that you are not currently using into fixed deposits. Now, fixed deposits back in the day had relatively good interest rates on them. Now, again, similar to simple bank accounts, the interest rates aren't as attractive as they used to be before. However, just keeping cash sitting, not doing anything with it, is a lost opportunity. So if you have some funds there that you're not ready to use, or maybe it is that you're waiting for an opportunity. For example, you're after a real estate investment, but that has not yet come true, and you want to be able to have those funds fairly liquid for when that opportunity arises, but at the same time, you want to be able to get something for your monies, then you can also consider a fixed deposit. Another option in terms of cash and cash equivalent type scenarios for passive income would be stock, dividends, bonds, EFTs, and mutual funds. Now, these are also options that you can embark on with relatively low investments. That is $100. Some of these options, obviously, you will have to have a brokerage account, which is a bit more effort. I'll go into brokerage accounts in a more detailed video, but for now, I will just say that stocks, dividends, bonds, EFTs, and mutual funds are options under the cash and cash equivalent. I'll start with the easier options in terms of getting into the market when it comes to passive incomes along the cash and cash equivalent. And those will tend to be government bonds. Now, generally, the government will issue a set of bonds which they're doing for the purpose of raising capital for whatever expenses or investments options or that they want to embark on. When these bonds are issued, they will tell you at what rate that they're being issued at, and that would be what level of interest you can expect, and they will generally have a maturity date. Now, once the bond issue has been placed on the market, you will be free to go to any commercial bank or financial institution who deals with buying and selling of government bonds, where you can purchase your own. You can determine how much of these bonds you want to buy, and they're generally in denominations. So they'll be either $50, $100, and you can determine if you want to buy $400 units, etc. Once that information is relayed, then you become the recipient of these government bonds. There will be a maturity date attached to them, and there will also be interest dates attached to them. So once the bonds have matured, whether it's a 10-year bond or a 20-year bond has matured, then you will receive back both the principal and the interest on that bond. Mutual funds. There are organizations out there, financial institutions, who their mandate is to provide mutual funds to the public. And some of these funds are funds that they're managing themselves, as in their own fund that they've created. And some of them are funds that they are selling on behalf of another institution. With a mutual fund, generally how it works is that the fund holder have basically embarked on a series of investments themselves. And this is information that you as a potential investor or as an investor would be privy to. So you'll be able to see exactly what they have invested in. A lot of the mutual funds in the Caribbean are actually invested in property and real estate. But there are also some that they will have other types of investments, and all of them will carry a certain level of cash or cash equivalents. Once they have invested in these particular investing activities, then they will receive either interest or appreciation for their investing activities. Investor, you are then entitled to a portion of that interest. To take fees for the fund, for the work in which they have done, and to pay their own expenses and their own profit. And then there's a portion that will be paid out to the investors or the mutual fund holders. And basically, as an investor, once you have made that initial investment, then you pretty much then sit back and you wait until the mutual fund has performed and receive your interest. Now, of course, as an investor, the onus is on you to make certain that you know what the fund is invested in, and that you do your research and educate yourself to the point where you can read the financial statements that they are putting out every quarter or every year to determine whether or not the investment is working for you. Stocks. Publicly traded companies, that is, companies who are trading on a public stock exchange, will go out to the public at different points in time to solicit funds for the purpose of carrying on their business. As an investor, you will then buy shares into these companies, and again, you will determine how many units you want to purchase, that is, how many shares, based on how much monies you have to invest. Once you've made that investment, the company then carries on their day-to-day activities, and at some periods of time, whether again it's quarterly or yearly, they will report back to the investors to let them know of the performance for that particular period. Now, the objective of all companies is basically to earn some level of profit for their shareholders. They may have a predetermined amount in which they are trying to achieve, or it could be a case where the expectation of the investors would be to receive a particular amount at the end of every year. Now, once they have achieved these targets, that interest then is paid out in the form of dividends. And sometimes you may see a notice in the newspaper or in some form of media where a particular company would say that for the period ended XYZ, they are preparing to dividends of, let's say, 5 cents per share. And that basically means that for every share that you own, that's the appreciation that you will get towards your investment. Again, this also means that you have to be that educated investor where you know the type of companies that you want to invest in, and you want to be able to keep abreast on what the company is doing, the type of activities that they're involved in, even in terms of like their corporate responsibility. You want to make certain that you are aware of what's going on with these companies and that you make informed decisions when you invest. Now, if you're investing in a particular company, no, the work is on you to ensure that you've done your homework and to know that this company is a company that will be able to provide that level of return that you are looking for. As opposed to, say, a mutual fund where the fund managers will go out and they are the ones who will do their homework with regards to what companies are best to invest in at this particular time. Now, if you're new to investing, it may all sound a little bit complicated, but I guarantee you it is not. You can just pick one avenue where you think that you are currently at in terms of whether you think you are more suited for mutual funds, bonds, or stocks, as in that you want to actively pursue and research companies. Once you've been able to establish that, you will also then seek to see how much funds you have to invest. Now remember that investing, there's also risk along with the rewards. And it doesn't necessarily mean that the higher the risk, the higher the rewards. As an investor, you will decide whether you want to be a low to moderate type risk person, whether you balance risk. That is that you are willing to put in X amount with the idea of getting the reward to match that, and whether or not you are a high risk person, and that is that you are willing to go higher in terms of how much you are investing and that risk because you deem the rewards to be of a higher level. How do you determine which risk category you fall into? It basically comes down to the purpose of why you are investing. If you are investing as a means to future revenues, or you are actually on a much younger scale, then you may have a higher tolerance level for the risk. If you are investing as in you need these funds to be part of your supplementary income, whether in your retirement age or currently, then you may opt for a more moderate to balanced risk. If you are very close to retirement age and at this point in time you just want to be able to maintain the wealth level that you have, then you may consider yourself to be at a lower risk. All levels of investing comes with a risk, but it is to determine which risk level you are at and then embark on that investing as an individual who has done their homework. The last category that I will speak on in terms of cash and cash passive income would be peer-to-peer lending. And there are companies or financial institutions out there who actually facilitate peer-to-peer lending. Peer-to-peer lending is basically where you will invest in a particular person or a particular small business so that they can get the capital or sometimes just the funds that they need for their day-to-day life, and you will earn a return for those monies that you are putting in towards that. If you are doing peer-to-peer lending on your own, it means that you basically found an individual that is in need of funds at this point in time, and you're willing to lend that individual these monies with certain criteria similar to how a bank would lend money to any person. And that is that you've established how much money you are lending them, the terms in which they will repay this money, and make certain that there is a legal agreement surrounding this. If you're using a company for peer-to-peer lending, then that company will have their own established legal agreements, and you will determine again how much monies you have to invest. It would be the company's job to go out and look for persons who are desirous of borrowing, and basically what they do is they act as the intermediary to match you to one individual who wants to borrow. They take care of the paperwork in the back end, and there are some of these companies that actually will guarantee you a refund. So let's say, for example, you had been matched with a farmer who wanted some capital to expand their farm, and they were able to do that with the monies that you had provided. And 2 years in, there was a natural disaster that eroded their farm, and they're no longer able to continue to make those loan payments. Then most of these peer-to-peer financial institutions will actually have some level of insurance in there where they can guarantee you that you will still return, that your funds will still be returned. Now, you have to ensure when you are signing up for the particular institution that this is one that actually does that, or how much of it you are guaranteed to get back. So always make certain that even if you are using a company for peer-to-peer lending, that you read the fine print and that you read the details and that you are comfortable with what the legal agreement is saying. Passive income is a really good way to strengthen your wealth journey. And while some of these strategies will take time for you to educate yourselves, or while some of these strategies will not necessarily bear fruit to the levels of income that you may want immediately, it's always a good avenue to pursue. Because with passive income, your monies are they're working for you while you sleep or while you simply enjoy life.